Right.
Is this a bull market or is this just a bear market rally?
I think it's a bear market rally. We have an inverted yield curve of about 100 basis points right now. You've got disinflation, which is continuing to accelerate, and that's just bad for corporate profits. I think what we've seen in the first half of the year, and again, I think we should pay attention to the full investing cycle, which started November of 21 when GDP growth and inflation growth both started to decelerate. That has not changed. ISM for services is below 50. There isn't really any good news. What we have seen is an uptick in liquidity in the beginning of the year. So we had the Treasury General account that they used during a debt ceiling count. So they didn't issue any net new debt in the first part of the year. That's why you saw liquidity go up. That's going to reverse itself. And so not only is the Treasury going to start pulling liquidity out of the market again, but you've also got student loan repayments that are going to start up again and the exhaustion of the business tax credits. So you're going to see liquidity come back down. My sense is that's going to be bearish for stocks.
Okay, so liquidity was also a concern, and perhaps even credit conditions a concern earlier this year when our country had the worst banking crisis it's had since the great financial crisis back in 2008, 2009.
Right.
The markets, Ivory, as you know and I know and everyone who listens or watches this program knows, shook it off in relatively short order. What does that then tell you about investor sentiment and how bad a fall could be if it were to happen?
Well, I think a lot of investors suffer from short-term return disorder, right? Because it hasn't really been completely addressed. 50% of banks in America have more liabilities than assets. What happened was the Fed came in and opened up the discount window and created liquidity for the held-to-maturity bonds. But that might be a short-term issue. But a bigger concern is how do you refinance all these obligations coming due? 40% of U.S. debt has to get refinanced in the next 2 years. 25% of commercial real estate loans come due in the next 12 months. And then you also have the $1.4 trillion private debt market that they gave the small. These are loans given to small and mid-sized companies on adjustable rate loans. They haven't been marked to the market yet. And pensions own 2/3 of these instruments. So I don't think we're out of the woods once you start looking at the refinance risk.
Okay, and before we let you go, Ivory, your job is to manage wealth.
Right.
You seem like you're a little bit more bearish, more conservative right now. You're not the only one out there. If that's the case, then what are you doing? Are you raising cash? Are you selling stocks at this time? Are you looking at some of these bond yields and saying maybe there's something more attractive in the Treasury side or even on credit?
Yeah. So instead of maybe being 60-40, you might be 40-60, but I'd have more gold. Even though it's backed off a little bit, I think it's a buying opportunity. You can still get 5% in a money market fund, and which is attractive if you consider that 7% of the stocks in the S&P 500, 7 stocks in the S&P 500 are like 90% of the returns this year. So it's not a broad-based rally. We might find that money markets outperform a big portion of the S&P 500. And then there might be some other opportunities. I'm looking at Japan's economy continues to grow on a rate of change basis. That might be an opportunity as well.